Dave, hey man, thanks for being with us today.
Hey, thanks for having me, guys. I'm looking
Yeah,
forward to it.
yeah, we're looking forward to it too. Before we get into kind of some of the meat of this interview, give our listeners a little bit of your background, right? You've got a pretty interesting background. We'd love to share that with them.
Yeah, so I was fortunate in that I grew up in a very entrepreneurial business sort of family. And so I grew up in business. My dad bought a manufacturing business the year I was born. So our family business is modular buildings. We build modular buildings. And I was growing up in that sort of environment. And I saw my dad investing in real estate. He was very successful in business. He started investing in real estate and farms and land and local properties and some single family homes. I saw him self-manage some of those single family homes. And I just quickly realized that, and this was when I was in my pre-teens and teens. And I realized that I wanted nothing to do with that. That wasn't going to be me when I grew up. I wasn't going to be a real estate investor. So anyway, so I went down the path of starting and owning and partnering in business when I was in my late teens, early 20s, and got to the point where some of the businesses started doing really well, and I got into a tax problem. I started having to pay lots of money in tax, and more than a decade ago, I was paying $500,000 a year in tax, and it running businesses and all that was. I was having all kinds of fun doing it. When I had to give half my money back to the government, it wasn't so much fun anymore. And I started going down this path to figure out how I can live tax efficient. And I heard Robert Kiyosaki talking about how you could make millions of dollars a year and pay no tax legally. And I'd heard Tom Wheelwright making statements, about, how you could control your own tax liability, how, if you want to change your tax, you got to change your facts. And so some of those kind of one-liners sort of changed my life and set me down in this path of discovery and searching. And I really got into the multifamily apartment space because I had a tax problem. So I ended up taking my tax liability from $500,000 a year down to zero. And it's stayed very close to zero for the last decade, all while, several times, all while 5 or 10xing my income. And so, this conventional thinking of if you make a lot of money, you got to pay a lot of taxes, just not true. And so I discovered that, and in discovering that, I realized there was a lot of other people that thought conventional. And so today I teach, how to invest, how to grow your wealth, and how to live a tax efficient life.
Well, that sounds very intriguing.
So how did you get started? Like, what did you discover? So you went down that road, you found multifamily, and what is it in multifamily that allowed you to offset that tax liability, Dave?
Yeah, so several things. So I started buying multifamily on my own, bought a couple hundred units of my own. I was, doing really well in business and bought a couple hundred units of my own. I was using cost segregation studies. I was using bonus depreciation. I was using leverage. And, within 1 year, because I bought several large apartment buildings and used those strategies, I was able to take my $500,000 tax liability down to zero. And so just by using, I made some changes. I changed the way, like Tom Wheelwright said, I changed the way I was behaving. I changed my facts. I didn't like my tax positions. I changed my facts. I started transitioning more into the investment world and real estate investing, and became a real estate professional and started using, my depreciation, bonus depreciation, cost segregation, started taking those losses and offsetting the tax liability on my ordinary income, which was a game changer for me. And so those are the strategies that I started with and started using. And it's really not that complicated. It's basically today I teach this stuff. Next weekend I'll be in Dallas teaching to 300-400 folks in Dallas, and it's really as simple as taking an income stream, whether that be ordinary income, whether that be passive income, whether that be capital gains income, really taking an income stream and then finding an asset class that that provides the depreciation to offset the tax liability on that specific income stream. And so it's as simple as that. I had an investor telling me about how she's setting up, some kind of entity structure, and then she's moving this, the capital over here, and then she's using some kind of, life insurance product, and then she, complicated. Those things can be done, but they're hard, they're complicated, and unless you're immersed in those things, you're probably not going to remember how to do them. Our strategy is finding an asset class that provides the depreciation that offsets the tax liability on a specific stream of income.
I heard something that's interesting in there, and what I'm hearing, you correct me if I'm wrong, Dave, is that you kind of started out looking at multifamily from the tax perspective. I think a lot of people approach multifamily from the income stream perspective. Would you agree with that?
Oh yeah, no, and in addition to building equity appreciation, building long-term wealth, building streams of income, all of that stuff. I mean, that's all of the reasons why you should be investing in real estate and multifamily and some of those asset classes. But for me, I needed help. I needed my most pressing issue was I had a $500,000 tax bill that I need to get rid of. And, knowing all that other stuff came along with the package, it's all good. But for me, my most immediate need, I led with my need. My most immediate need was I wanted to keep the money I was making.
So you were kind of got into this just for a personal reason. When did you start the Real Asset Investor?
Started the Real Asset Investor not quite 10 years ago. Personally, I've been an investor and an entrepreneur all my adult life. So, I was an investor long before I started the Real Asset Investor as an entity, as a business to help other people kind of sort of do what I was already doing. And that's really what we do at its core is I take things that work for me. I take my problems and figure out how to fix my problems. And I take asset classes that I really love. I take operator teams that I really love, and then I share it. I take it to my investors and I say, hey, this is what I'm doing for myself. And, it's sort of a two-pronged approach. On the one side, I'm helping an investor get what they want. That is to live the more tax efficient life, build income streams, build wealth. On the other side, I'm working with I'm working with an operator that's, very proficient in the asset class that they're operating. And I'll give you an example. We're doing business with a self-storage operator, one of the best self-storage operators in the country. We just rolled up 26 of our self-storage properties last November and sold them to a REIT out of Chicago. And it was a big institutional deal. And our investors netted 30 to 31% annualized on average in that portfolio. And so, just being able to kind of tap into the operator, come alongside of them, be a funding source for them, help them grow and scale their business on that side, and then helping the investor build wealth on this side. It's kind of a two-pronged approach, and that's what we do best. And it really starts, this is going to sound incredibly selfish, but it really starts with me. It starts with, what do I want? What do I want to invest in? And why do I want to invest in that asset class? And then, once I have my problem taken care of and we got that sort of infrastructure built with the team and all that, then I take it to my investors and say, hey, this is an option. This is an asset class that you might want to consider.
And I can appreciate that. I think that Anthony and I have shared our story on our podcast over the years, and it's a very similar story, right? We were trying to solve our own problems that we had. We came across something that was successful, and then we just started sharing it, right? That's what I'm hearing you say as well. Dave, also, I heard that you were in multifamily and self-storage, but tell us how you got started in ATMs.
So while I was building my multifamily asset class portfolio, while I was doing that, I really got into the syndication space by accident. I was I was raising money for self-storage. I had bought a bunch of units of my own, ran out of my own money. Now I've got the team set up, so I started, inviting friends and family and business associates into the deal, and sort of just kind of became a syndicator without really trying. So I was doing all that, and I was making passive investments with with a couple local operators here in Lancaster, Pennsylvania. I started investing passively in ATMs. And these were, highly regarded business guys in the area, well-respected business guys. I thought it was very interesting. 100% bonus depreciation, cash flows in the 20+% range. I'm like, man, what's not to like? So I started investing with them passively. This went on from 2012 to about 2016. They came to me in 2016 and said, "Hey, we're seeing what you're doing over in the multifamily space. We just signed on a large portfolio of ATMs. Come help us." And so I joined the team. I partnered with them. Really, we took that business from a small mom and pop or a small friends and family sort of operation, small kind of fun for friends and family. And we've really scaled that business since 2016. And today we're one of the top 4 ATM operators in the country.
Awesome. You mentioned we had a gentleman on that we interviewed late last year. I think it was December.
Yeah.
But we interviewed him, and what he does is he helps individuals build kind of an ATM business. What I heard you say is you bought a portfolio. Can you maybe highlight the differences or what you guys are doing? Because I think there is a pretty big difference between our previous ATM conversation and what you're talking about here.
Yeah, so we're not going into single locations, restaurants, bars, trying to acquire these. We're dealing with institutional grade portfolios, and we're also not putting. Typically, we're not putting new ATMs in new locations. When we're buying a portfolio of ATMs, it could be a $5, $10, $15, $20 million purchase, and we're buying existing ATMs in existing locations, and we're unseating somebody. We're coming in and taking over those positions, and that's important for a couple reasons. Number one, and probably most important, is we're taking a lot of risk out of the deal. We know exactly how many locations that portfolio has delivered over the last couple of years. We know we can drill down into the location and know exactly how many transactions that specific location did in the last 12, 24, 36 months. The other thing that's important, we're not putting a bunch of new ATMs in a bunch of new locations and getting into the point where we're saturating a market. So we're taking over the locations, reducing a lot of risk because we're doing our homework ahead of time.
So what I'm hearing is that the locations are already proven to be profitable. If we're doing a new location, we don't have that history of transactions that it could be profitable or it could not.
Yeah, I mean, so what does a bank or a lender want to see, or a buyer want to see when they're going in to buy a multifamily apartment building? They're going to ask for a T12. They want to see the history. They want to see where the money's coming from and that it's consistent. That's exactly what we're doing in the ATM space. We're going in. We're getting that operating history. We're getting that transaction history. We want to see that this is a proven location, and that takes a lot of risk out of the deal for our investors.
Dave, let's just for maybe some people who might be new to the ATMs or as a business, because a lot of people probably assume all ATMs are owned by banks. So do you want to allude to the difference between bank owned and privately owned, and how does an ATM make money?
So many people believe that banks own the ATMs, but I will tell you that even the ATMs inside the banks, many times those aren't bank owned. Those are owned by us. The other thing is when you walk into a Wawa or a Sheetz, a convenience store, and they have the sign hanging there, it's like free ATM, surcharge, no fees. Well, there is a fee. they're just covering that fee for you because they're hoping you take $50 out of the machine and buy a whole bunch of stuff in their store. Either way, you don't get a free, there are fees, even though you, the consumer, might not be paying the fees, but we're collecting those fees when we have our ATMs in those stores. So typically what happens, you walk up to the ATM, you swipe your card, you get your cash out, and there's a $2.50 to $3.50 surcharge that gets applied to your to the cost to make that transaction happen. On the other end of that surcharge, there's an investor that's making a nice juicy profit from that transaction.
Now, I would kind of, my first reaction is I'm not using, I rarely use cash. And when I do, I'm not paying that convenience fee. I mean, we're always hearing now we're going to cashless society. How would that impact ATMs?
What do you like? What's your favorite asset class? What do you like to invest in?
Real estate. Cameron likes hair products, but I like real assets, like real estate.
You're talking like real estate, like as in multifamily apartment buildings, A, B, C class, any of that?
I personally, I like single family.
Okay. So I've had people say to me exactly what you said. I don't use cash, so why would I invest in that deal? And those same people, I know have invested in B and C class, multifamily apartment buildings. And my answer is, well, you invest in B and C class multifamily apartment building, but you would never live there with your family, right? I mean, and so what you got to remember is, you and I, and probably most of the people on, listening to this show, are not our customers. We've long since transitioned to plastic, and so we don't use cash. I very seldom use cash, and I don't use an ATM. I couldn't get money. I own hundreds of ATMs personally. I couldn't get money out of an ATM machine if I wanted to. I don't have an ATM card. Here's who our customer is. Our customer is the lower income EBT card carriers. They're unbanked. They're underbanked. They're immigrants. They're using this ATM as their bank. They're sending money overseas. They're cashing checks. There's all kinds of things that they're using this ATM for. Now picture this. So there's a guy who used to work in a factory and who used to get a check every Friday night or every other Friday night. Today, that doesn't happen. That now that money is ACH'd into his bank account. So he walks out of his C-class multifamily apartment building. He walks down to the corner deli. He takes out $20 or $30 in cash, and he goes and buys cigarettes. Or he takes, she takes her EBT card that she can't use to buy prepared foods, and she goes over to the ATM, quickly converts it into cash. Now she can buy whatever she wants. So those are the type of customers that we're servicing. And when you realize it's one of the fastest growing demographics in this country, then this business model starts making a lot more sense.
Interesting.
Now, where I've heard of these crypto machines, these crypto ATM machines. Are you involved with that, or what do you see in regards to those?
Yeah, so our management team owns about 1,500 of these BTM machines. It's funny that you ask and the timing of the question, because we just finished the investment summary and we're getting ready to launch the fund later on this month. So yes, we have a proven business model. We own about 1,500 of the BTMs, and the margins are even better on the BTM side than they are on the ATM side, and it's we're looking forward to it. This is something that's been in the works for us for the last year and a half to 2 years, and we're finally launching the fund. It looks like this month.
Where are you guys going to acquire these, right? You said you're not going to kind of mom and pops. Where are you acquiring, and how many do you guys have right now?
So we got about 1,500 BTMs, we're buying the machines brand new. And we've had these in service, in operation for the last 18 to 24 months.
So you guys are coming in, buying a package of these things and then putting in a new machine. I thought I'd heard earlier that they were already in an established location.
Those are different because there's so few of them. There's not portfolios available like there is in the ATM space, but we do know that many of those same people that are using our ATM machines are also using BTMs. And so we got a huge advantage to somebody who's just new to market and going to be placing BTMs because we already have the relationships with the convenience stores and with our partners who already have our ATMs in their store. Now we'll be able to leverage those relationships further and just put a BTM right beside it.
Oh, so you're going to put them right next to each other.
Yeah, the ideal scenario, and this is kind of a joke, but the ideal scenario is where you would go in and take cash out of the ATM machine and put that cash into the BTM machine, and you'd get Bitcoin with it.
Oh, perfect. I can imagine they eventually might make one machine that did both, I would assume.
Well, they do, and they have, and some of our ATMs are BTM compatible, but what we found is the performance on a standalone BTM is so much better than if it's a hybrid.
Interesting. That is very interesting. Now, Dave, tell us what this looks like if somebody were to invest. What exactly are they getting,
and how much does it take?
Yeah.
Yep. So you're investing into a fund. You as an investor own a small piece of the fund. It's no different than if you were investing in a multifamily apartment building. You don't own a piece of the multifamily apartment building. You own a piece of the entity that owns the building. Okay. So you're investing in a fund. Let's say you invest in a unit of ATMs, which is 5 or 6 ATM machines, for $104,000. We then take those ATM machines and put them in our fund. Those get managed by a third-party ATM management company, which has some overlap in ownership in our partnership team. But those get managed by the ATM management company, and you get a piece of the revenue. And typically what you can expect from that revenue split or revenue share is it's sort of a three-pronged approach where the customer swipes the card. So let's just call that a $3 transaction. Roughly 40% of the revenue goes to the management company, where all of the costs and overhead and fees and from maintenance to cash delivery and all the costs flow through to the management company. The management company gets roughly 40% of that $3 surcharge. And then it goes to the location owner to service the location agreement. That can be through a fixed rent, or it can be through some sort of revenue share, or more often it can be a combination of both. And then there's about a 30% split with the investor. Now, those, that is variable, and that fee structure varies from fund to fund and portfolio to portfolio, but that's kind of the general idea, pretty much kind of a 40-30-30 split.
Okay, and can you disclose about what the investor would look at getting?
Sure. Yeah. So right now we have a fund, or for the last roughly 12 months, we had this fund open. The fund pays $2,142 per unit. So you make a $104,000 investment, you get $2,142 per unit, and that's a 7-year contract. So the way those returns look, it's a 24.5% cash on cash return, but the IRR is really what you want to pay attention to, because when you look at just a straight out return, you're really owning the ATM machines, but what you're doing is you're purchasing a cash flow stream and a tax benefit. So consider what it would look like if you were to buy 5 or 6 laptop computers. That's really what you're doing when you're buying a piece of technology. You're buying an ATM. You're not buying the ATM for the ATM. You're buying the ATM to facilitate and getting you that cash flow stream and that tax benefit. So really what happens is that 24.5% cash on cash return on the front end is not reflective of the loss of value of your equipment over that 7-year period. So when you look at it from an IRR perspective, then you're around a 19% IRR. So, unlike in what you would consider in real assets where the cash flow is lower and the IRR is higher, here it's just the opposite, where your IRR is lower than your actual cash flow because you consider the value, the decreasing or declining value of your asset over that 7-year period.
Okay, now explain the tax benefits.
That's one of the most fun things about this investment. Okay, so we never start with tax. We want to make sure this investment works. We want to make sure you build wealth and build income streams and all that. Mm-hmm. But this is one of my favorite tax planning weapons. I mean, 100% bonus depreciation in year one is hard to argue with. And, as you can imagine, Q4 is, our activity ramps up because I use it for my tax planning. And there's a lot of people that use it for their tax planning. You get 100% bonus depreciation. You can come in as late as October and you can get 100% bonus depreciation for that year. So what that looks like is you make that $104,000 investment into 1 unit of ATM machine. Your K1 shows up in Q1 of the following year, and you're showing $104,000 loss for making that investment. And then, and here's the beauty of that. So let's say you're an investor in the high tax bracket. So you take that tax saving, which is a direct impact on your tax liability. You never have to recapture that depreciation. So you really got to count that as income because it comes right off the bottom of your tax bill and you never recapture it. So you take your tax savings, then you take your first 12 months of cash flow. You got 60 to 70%. You got 60 to 70% of your principal back in your pocket, and you still got an additional 6 years of cash flow beyond that.
Okay, David, hold up. Okay, that was some good stuff. I'm still at writing you a check for 104 and then taking a deduction for 104. That's pretty cool, super cool. So is that because that 104 is allocated to the purchase of the machines?
That's because you're investing in new equipment, and that new equipment has this year yet you get 100% bonus depreciation against new equipment.
Now, I would assume that this is considered a passive loss.
Correct.
Okay, so in order to deduct that, we're going to have those limits, those passive loss limits.
Yeah, so there's a couple things. One, it is passive activity. Mm-hmm. It will offset your passive income. It will offset capital gains. It will offset depreciation recapture. Okay, so let's say you're a W-2 employee and you don't have other passive activity, passive gains, passive cash flow that you can't use that those passive losses, that $104,000 depreciation we just talked about. Mm-hmm. That doesn't mean that it goes wasted. That means that it just sits there in a bucket and it waits till you're ready. It waits till you provide that cash flow, which comes from your ATM investment. So the most conservative way to use that is just let that sit in a bucket, and then you let your cash flow, let your cash flow accumulate, and that gives you tax-free cash flow for the next 4 years. So while you're still a W-2 employee and you're making ordinary income, now you're starting to build your passive income column. And even after you get beyond the next 4 years, and now your income starts getting taxed. Now you're talking passive income, and you got all kinds of different ways you can offset tax liability on passive income. W-2 income.
What you could do, Dave? Maybe you write you another check for $104,000. And then we have those passive income that we could deduct those losses.
Yeah, no, and that's what it's about. You know, at the end of the day, you know, one of the goals for me early on was to make get my passive income to the point where it exceeds my ordinary income. And you know, you should never pay tax on your passive income. You know, you should never pay tax on your ordinary income either, but that's a lot harder. Um, you know, you just got to use more advanced strategies, and the options are fewer on that side. On the passive income side, your options are pretty much unlimited. I mean, you can invest in a lot of things and offset the tax liability on your passive income.
So then I know there's a lot of people that unfortunately have a lot of their wealth tied up in 401ks and IRAs. And, you know, they can, you know, convert that into a self-directed IRA. What do you think on using that money? I mean, we're going to lose the tax deductions, but what's your thought on using qualified money?
So it's not terrible. You leave some benefit, you leave some margin on the table when you can't harvest those tax benefits. And here's where it's especially important to remember: when you do that in a self-storage facility, and you know, you can't use the tax benefits. Okay, when you sell the self-storage facility, you know, now you don't have to do a recapture because you never harvested those tax benefits anyway. Well, here it's a little bit different because you never recaptured this depreciation. So if you don't use it, you lose it. And so at the end of the day, it still delivers. Like if you strip out all of the tax benefits and you just consider the cash flow and you consider the loss of value of your equipment over that 7-year period, it's still a double-digit return. So it's not terrible. You just leave some margin on the table.
You know, I'm now I got my brain ticking. And Dave, I know you're not giving tax advice, nor are we. Okay. But one theory I was thinking is, if assuming you had some passive income, maybe from another syndication or another business, and you had this money inside an IRA, you could withdraw it, take a withdrawal. So now your tax, you have to claim that as income, but we turn around and put it in your syndication, and we can, in theory, offset that money, a way for us to take away the tax from our IRA.
So almost one of the things that one of the reasons we don't like investing in Wall Street products, which is oftentimes what, you know, 401ks and a lot of those retirement accounts are invested in. Many people don't even realize what they're invested in, but they're, you know, typically being managed or invested in some sort of Wall Street product, ETFs, whatever. You would think that when you purchase an Apple stock or an ETF, you hit the buy button, you make the purchase, you sit on it for 10 years, you turn around and sell it in 10 years. That's pretty passive, right? I mean, you don't actively run the business. You don't, you know, you're not actively involved. You don't do anything. And, you know, it should be pretty passive, correct? But what happens is you get taxed on that as ordinary income. So you can't take passive activity like an ATM investment or like a syndication that you invested in and you're investing with an operator or whatever. You can't take those losses to offset the tax liability on that 401, on that gain in your 401 many times. So that's the other reason why we like to invest in real assets that deliver cash flow and that provide that real value and upside, is because you're not bound to those rules and they don't get you coming and going, and you have some options. You're not getting taxed at ordinary income like you do when you cash out of your 401k or your retirement accounts.
Now, I would say, Dave, this sounds great. I mean, it's very interesting, but you want, just being real, every time we talk to somebody with a syndication or some business plan, it always sounds great, right? Or they wouldn't be promoting it. But I got to imagine that there's pros and cons to everything. and I'm sure that there's some risks in investing in this. You mind sharing what some of those could be, Dave?
Yeah. So you're talking about risks in the ATM business?
Yeah.
Yeah. So when I see the risk in the ATM business, I mean, there's really one risk, and that is, we make our money on the volume of the transactions that happen at our ATMs. So the risk is that the volume would decline. And so then you got to ask the question, okay, what could make that volume decline? Well, it could be people quit using cash, or it could be, that's really, in my mind, that's really the number one risk. Because as long as people are using cash, there will be a need for a mobile bank or an ATM machine. And so you asked, you made mention of this a couple of minutes ago about digital currency and what that's going to look like. I guess I'm a little bit calloused to those conversations, just simply because I've been hearing them for the last 11 years, ever since I got into the space. Back then it was Apple Pay, it was Google Wallet, it was some of those new technologies that were coming on, and you can go back as far as the 1990s, where there was articles in the Wall Street Journal that talked about the death of cash, and we're only going to be using cash for a couple more years, and so that talk has been going on for a very long time. And what we've seen is, despite Apple Pay, Google Wallet, Venmo, Cash App, cryptocurrencies, and I mean, the list goes on. Despite all that, the use of cash has grown and has more than doubled in the last decade. And so we would there's this subset of the population that has used cash all of their life, and we would expect them to use cash for the next decade or more.
Dave, I've got a question for you. You mentioned that you were personally investing in ATMs, I think, all the way back to 2012, if I remember right.
Yes.
Did I hear that accurate? What opportunities are you looking at now? Right. That what opportunities do you see in the marketplace today?
So I eat my own cooking. I will make another 7-figure investment in ATMs this year. In fact, we were just talking about this morning. My largest investment this year will be in the car wash space. The largest investment that I've made to date this year is in the car wash space. And, I really just take like I was explaining before, that stream of income, whether it's ordinary income, whether it's passive income, whether it's capital gains, if I sold anything, I really just take my picture and I say, okay, what do I need to do to offset the tax liability in those different asset classes or those different income streams? I got to find an asset class that matches up with that income stream and knocks down the tax liability on that income. So I mean, the asset classes that you see us go to market with are asset classes. Those are the asset classes that I'm invested in personally. So I'll have heavy investments in the ATM space. I'll have heavy investments in the car wash space. Biggest investment I've made this year. I'll invest in, I have some energy investments that I like. Self-storage is another one. I love self-storage. I was just talking to a guy this morning about data centers, and he sold his tech company. They service data centers. Those data centers in the last decade has been the only commercial asset class that has outperformed self-storage, and that happened in the last 2 years. Prior to that, coming out of 2008, 9, and 10, self-storage was the best performing commercial real estate asset class in the country. And so I like self-storage for a number of reasons. One of my favorite reasons is it does really, really well in times of disruption, pandemics, recessions, divorce, downside, dislocation, all those things. And it provides stability to a portfolio that, where, if everything else goes bad, typically self-storage shines. And self-storage does really well even in good times.
Dave, I would love to have you back on to talk about car wash. That's a topic we haven't addressed. So we'd love to have you back if you're willing.
I would love to come back. Self-storage is one of my favorites. Just simply one of the reasons is because of the opportunity that I see in the marketplace. It is a very fragmented asset class or business. It's like 5% of car washes are owned by institutions. The rest are owned by mom and pops and individuals. The institutional appetite, private equity institutional appetite for this asset class is off the charts. One of my partners was very involved at JP Morgan. He was a very high paid deal maker, and he was on the deal maker side of JP Morgan. And so he comes to us, he was like, hey, the last 4 car wash, tunnel wash portfolios that have traded in the around a 20x multiple, 20 times EBITDA. And then it was interesting, like about 2 weeks ago, the Wall Street Journal came out with a big old article, and I wrote about this in a newsletter of mine that talked about it. They were saying, the average tunnel wash, their earnings are X, and they're trading at 18 to 20x multiples, and it's like yeah, we know, and it was sort of a confirmation, but it's an exciting space right now, and we're really racing to get to 50 or 60 car washes in the next 4 years, and we plan to sell into that into those kind of multiples.
Dave, 2 things as we wrap up here. If somebody's listening and they want to reach out to you, where can they get a hold of you at?
The best place to go is info@therealassetinvestor.com, and that's also on our website, therealassetinvestor.com. But info@therealassetinvestor.com gets all of us. It gets my team, and if when some of your folks reach out to us, we will get back to them. We're very prompt with that. So info@therealassetinvestor.com is the best place to go.
Great. We'll make sure we put that in the show notes. And then the other one was, you alluded to the fact that you're going to be teaching in Dallas. Maybe share a little bit about what that event looks like. Is that a 1-day, 2-day event? And who should be there?
That's a 2-day event. So that's the secrets of successful syndication put on by the real estate guys. I've been a faculty member there for the last, 5-6 years. And so that's a twice a year event. And it's one that I like to go to. That's typically an every 6-month deal for me. I mean, I rarely miss one. And the reason I rarely miss one, number one, I love teaching this stuff. And number two, actually, you know what? I'll make the other one number one. Number one, the quality of people in the room, they know how to attract a good crowd. And the quality of people in the room is amazing. Just be able to, it's kind of gotten to be my tribe over the last decade. And, number two is I like doing this stuff. I like teaching people that, conventional thinking probably isn't going to get you where you want to go. And to be able to kind of put a twist on that and say, here's what you ought to really be thinking about. And here's the options that are really open to you. And this is how it really works in the real world. If you want to build wealth, one of the biggest crusher of dreams in building wealth is when you got to pay a 40% tax. And so if you can get rid of that, you're on your way to freedom much more quickly and efficiently.
Well said, Dave. I couldn't agree with you more. Thanks for being on today.
Thanks for having me. I enjoyed it.
Go make it a fantastic day.
Take care.
All right. See you guys.
I don't know how to end the live.
I think if you back out of there.
Exit. 1 second. End broadcast.